Akash Prakash, founder and CEO of Amansa Capital, a Singapore based foreign institutional investor which focuses on investing in India, explained his philosophy in Saurabh's first book, Gurus of Chaos 2014. As our view has always been that we need to invest in companies where we can trust in the people who are running the company. Trust, in turn, is driven by capital allocation, where you get shafted by entrepreneurs other than through theft and bad accounting by crooks, is capital allocation. In an environment like India, where you always have so many perceived good opportunities, if you invest in poor capital allocators, you will never get a return. Secondly, our firm belief is that good management teams create optionality for you. In an environment like India, smart managers can create a lot of wealth. Therefore, even more important than the buy decision is how long you let that position run. At Morgan Stanley, at its peak, we owned 14% of Infosys, and I was responsible largely for that position. I don't think we deserve great credit for buying Infosys. What's credit worthy is that we held it on to it for so long. Unless a stock reaches an absurd valuation, or if something fundamental has changed in the business environment for that company, or something critical has changed in the company's growth outlook, we prefer not to sell the stock that we own. Our view is that there are a limited number of companies in India where everything lines up: good business, capable and ethical management. You have access to the management. Such combination do not come often. Our learning from legendary investors like Warren Buffett, Akash Prakash, Sanjoy Bhattacharya, and K.N. Sivasubramaniam is that to consistently generate healthy returns from equity investing, one has to invest in high quality companies and then sit tight for long, often very long, without losing sleep about where the share price is going. The coffee can portfolio, robust returns with a low degree of uncertainty. Headquartered in Los Angeles, Capital Group is one of the world's largest asset management firms with assets under management in excess of 1.4 trillion US dollars. In the late 1960s, Capital Group set up entity called Capital Guardian Trust Company, whose aim was to provide traditional investment counseling services to wealthy individuals. Robert Kirby joined Capital in 1965 as the main investment manager in Capital Guardian Trust, where his job involved advising high net worth clients on investment and managing their portfolios. Nearly 20 years later, he wrote a remarkable note which introduced to the world the concept of the coffee can portfolio. Kirby, in a note written in 1984, narrated an incident involving his client's husband. The gentleman had purchased stocks recommended by Kirby in denominations of USD 5,000 each, but unlike Kirby, did not sell anything from the portfolio. This process of buying when Kirby bought but not selling thereafter led to enormous wealth creation for the client over a period of about 10 years. The wealth creation was mainly on account of one position transforming to a jumbo holding worth over 800,000 US dollars, which came from a zillion shares of Xerox. Impressed by the approach of buy and forget, Kirby coined the term coffee can portfolio, a term in which the coffee can harks back to the Wild West when Americans, before the widespread advent of banks, saved their valuables in a coffee can and kept it under a mattress. Although Kirby made the discovery of the coffee can portfolio sound serendipitous, the central insight behind this construct that in order to truly become rich, an investor has to let a sensibly constructed portfolio stay untouched for a long period of time is as powerful as it is profound. After all, the instinctive thing for hardworking, intelligent investors is to try and optimize his portfolio periodically, usually once a year. It is very hard for investors to leave a portfolio untouched for 10 years. A retail investor will be tempted to intervene whenever he sees stock in the portfolio sag in price. A professional investor will feel that he has a fiduciary responsibility to intervene if parts of the portfolio are underperforming. But Kirby's counterintuitive insight is that an investor will make way for more money if he leaves the portfolio untouched. 5 years ago, inspired by Kirby's 1984 note on coffee can portfolio, analysts at Ambit decided to recreate the coffee can portfolio for Indian equity investors. The coffee can portfolio comes to India. In the Indian context, we have built the coffee can portfolio using a simple construct. We use straightforward investment filters to identify 10 to 25 high quality stocks and then leave the portfolio untouched for a decade. Both in backtesting and in the live portfolios that we manage for our clients, we have found that this simple approach delivers consistently impressive results. In particular, the portfolio not only outperforms the benchmark consistently, it also delivers healthy absolute returns, and more specifically, it performs extremely well when the broader market is experiencing stress. Before we detail the return delivered by the coffee can portfolio, let us explain the simple investment filters that we employ. To begin with, of approximately 5,000 listed companies in India, we will limit our search to companies with a minimum market capitalization of 100 crores. As the reliability of data on the company is smaller than this, is somewhat suspect. There are around 1,500 listed companies in India with a market cap of above 100 crores. Then we look for companies that over the preceding decade have grown sales each by at least 10% alongside generating a return on capital employed pre-tax of at least 15%. Why return on capital employed ROCE? A company deploys capital in assets which in turn generate cash flow and profits. The total capital deployed by the company consists of equity and debt. ROCE is a metric that measures the efficiency of capital deployment for a company, calculated as a ratio of earning before interest and tax, EBIT, in the numerator and capital employed, that is sum of debt liabilities and shareholders' equity, in the denominator. The higher the ROCE, the better the company's efficiency of capital deployment. Why use ROCE filter for 15%? We use 15% as a minimum because we believe that in the bare minimum return required to beat the cost of capital. Adding the risk-free rate 8% in India to the equity risk premium of 6.5 to 7% gives the cost of capital broadly in that range. The equity risk premium in turn is calculated as 4%, the long-term US equity risk premium, plus 2.5% to account for India's credit rating, which is triple B as per S&P. A country's credit rating affects the risk premium as a higher rating, example AAA AA, indicates greater economic stability in the country, which lowers the risk premium for investing in that country and vice versa. Why use a revenue growth filter of 10% every year? India's nominal GDP growth rate has averaged 13.8% over the past 10 years. Nominal GDP growth is different from real GDP growth, as, unlike the latter, nominal GDP growth is not adjusted for inflation. In simple terms, it is GDP evaluated at current market prices, that is, GDP being the monetary value of all the finished goods and services produced within a country's border in a specific time period. A credible firm operating in India should therefore be able to deliver sales growth of at least that much every year. However, very few listed companies, only 9 out of the 1,300 firms run under our screen, have managed to achieve these. Therefore, we reduce the filter rate modestly to 10%. That is, we look for companies that have delivered revenue growth of 10% every year for 10 consecutive years. For financial services stocks, we modify the filter on ROE and sales growth as follows. ROE of 15%, we prefer return on equity over return on assets because this is a fairer measure for banks and other lenders' ability to generate higher income efficiently on a given equity capital base over time. Loan growth of 15%. Given that nominal GDP growth in India has averaged 13.8% over the past 10 years, loan growth of at least 15% is an indication of a bank's ability to lend over business cycles. Strong lenders ride the down cycle better as a competitive advantage surrounding their ability to source lending opportunities, credit appraisal, and collection of outstanding loans ensure that they continue their growth profitably either through the market share improvements or by upping the ante in the sectors that are resilient during a downturn. Now let's look at the results. Detailed backtesting of the coffee can portfolio based on data going back to 1991 shows that such a portfolio beats benchmarks across all time periods. The portfolio also performs admirably well during stressful periods like the Lehman crisis in 2008, when the overall stock market nosedived. If invested for over a decade with no churn, this portfolio generates returns that are substantially higher than the benchmark. Median compounded annualized outperformance of 11.9 percent points. Exhibit 6. The CCP has outperformed benchmark indices over all its 17 iterations. In the next exhibit, we have analyzed the performance of these 17 historical iterations of coffee can portfolio, with each portfolio lasting for up to 10 years of holding period, that is 125 years of cumulative portfolio investments. The median portfolio return, compounded and analyzed, has remained robust at around 24 to 25% historically, regardless of whether the investor's holding period has been as short as 3 years or as long as 10 years. Moreover, the coffee can portfolio also delivers an extremely low level of volatility in these analyzed returns for all holding periods, a necessary condition for investors to hold large exposure to equities in their net worth. In more technical terms, analyzing the numbers behind the table above shows that over the past 17 years, the coffee can portfolio's return within two standard deviations, that is the 95% probability interval, have been positive for all holding periods of 3 years or more, and have been in excess of 9% per annum for all holding periods of 5 years or more. In simple terms, it means that the historical data suggests that coffee can portfolio offers more than 95% probability of generating a positive return as long as investors hold the portfolio for at least 3 years. If held for at least 5 years, there is more than 95% probability of generating a return greater than 9%. Exhibit 7. Coffee can portfolio returns have been robust across various holding periods x axis with limited volatility in these returns as depicted by the height of the vertical bars which measure two standard deviations 95 midpoint confidence interval of returns. Just to emphasize the importance of 24 to 25% midpoint CAGR portfolio returns, a run rate of 26% return per annum results in the portfolio growing in size to 10 times in 10 years, 100 times in 20 years, and 1000 times in 30 years. Why does the coffee can portfolio perform so well? The ancient Romans were used to being defeated. Like the rulers of history's great empires, they could lose battles after battle but still win the war. An empire that cannot sustain a blow and remain standing is not really an empire. Many historians are of the view that the greatness of the kingdom or an empire should be measured by its longevity. How long did the empire last? How durable was it? By this measure, the first great empire was arguably the Persian Empire. Founded around 550 BC, it lasted for around 200 years until Alexander the Great's rise in 330 BC after defeating King Darius III. However, if longevity is the measure of a great empire, then the Roman Empire is possibly the greatest empire the world has ever seen. Whilst the first Roman Republic, headquartered in Rome, lasted from 100 BC to 400 AD, The imperial successor to the Republic lasted for a staggering 1400 years before falling to the Ottoman Turks in 1453. So ubiquitous is the influence of this empire that the language in which we are writing this book, the legal system, which underpins the contract between the publisher and the authors of this book, the mathematical concept of compounding, which underpins much of this book, all of them come more or less directly from the Roman Empire. When it comes to investing in stock markets, greatness is defined as the ability of a company to grow whilst sustaining its moat over long periods of time. This then enables such great companies to sustain superior financial performance over several decades. The coffee can philosophy of investing is built using the twin filters to identify great companies that have the DNA to sustain their competitive advantages over 10 to 20 years or longer. This is because greatness, which the coffee can portfolio seeks, is not temporary and definitely not a short term phenomena. Greatness does not change from one quarterly result to another. In fact, great companies can endure difficult economic conditions. Their growth is not beholden to domestic or global growth. They thrive in economic down cycles as well. Great companies do not get disrupted by evolution in their customers' preferences or competitors or operational aspects of their business. Their management teams have strategies that deliver results better than their competition can. These great companies effectively separate themselves from the competition using these strategies. Over time, they learn from their mistakes and increase the distance between themselves and their competition. Often, such companies appear conservative. However, they do not confuse conservatism with complacency. They simply bide their time before making the right move. These traits are rarely found outside great companies. Why choose revenue growth and ROCE as a financial matrix to measure greatness? Charlie Munger, vice chairman of Berkshire Hathaway, stated in his lecture at the University of Southern California in 1994, over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. Over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. Munger meant that returns generated by any company's share price in the long term cannot be significantly more than the return on capital employed generated by the company in its day to day business. He explained this with an example. If the business earns 6% on capital over 40 years and you hold it for those 40 years, you are not going to make much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you will end up with one hell of a result. Whilst there are several factors affecting short term share price performance, as shown in the exhibit below, earnings is the biggest driver of stock market returns in the long run. Exhibit 8, Sensex returns have mirrored earnings growth over long periods of time. Having established earnings as the biggest driver of share price, the next question to be answered is what drives earnings growth? Intuitively, one might imagine that earnings growth is an independent metric. The more products or services you can sell, the more revenues you book and the more profits you deliver. Rather than considering earning growth as an independent metric by itself, it is more useful to see earnings growth to be an outcome of two independent parameters: growth in capital employed in a business and the firm's ability to generate a certain return on capital employed ROCE. As a result, earnings growth can be achieved either by growing capital employed whilst maintaining ROCE or by growing ROCE through enhanced operational efficiencies whilst maintaining the firm's capital employed. On similar lines, Warren Buffett, in his 2007 letter to shareholders, defined three categories of businesses based on return on capital. First, high earning business with low capital requirements. The first example refers to a business like C's Candies, a chain of candy and chocolate stores in California that Mr. Buffet owns. These businesses cannot, for an extended period, reinvest a large portion of their earnings internally at high rates of return. However, in light of the firm's pricing power, C's Candies earnings keep growing without needing incremental capital, thus steadily delivering a high return on rather low capital employed. Typically, for such companies, two factors help minimize the funds required for operations. First, the product is sold for cash, which eliminates the need to wait for the customer to pay up and thus reduce account receivables. Second, the production and distribution cycle is short, which minimizes inventories. Such a business is eventually becomes like a cash machine, allowing investors to use that steady stream of cash to buy other attractive businesses. In the Indian context, Hindustan Unilever is an example of this type of business. Number two, businesses that require capital to grow and generate decent ROCE. Buffet says that the businesses described above are extremely difficult to find. Typically, companies require additional capital to keep growing their earnings. That is because growing businesses have both working capital needs, which increase in proportion to sales growth, and significant requirement fixed asset investment. Such businesses also form a decent investment option as long as they enjoy durable competitive advantages that can lead to attractive return on the incremental capital employed. An example of this type of business is HDFC Bank. As described by Saurabh Mukherjea in his best selling book, The Unusual Billionaires, a rupee invested in HDFC Bank at its IPO in March 1995 is worth rupees 134 now in April 2016, implying a CAGR of 26%. At the heart of this outstanding performance, there have been a. A risk aware culture that focuses on generating healthy returns without taking high risk. B. An internal architecture that has consistently allowed the bank to innovatively rethink the core process flows that characterize the central offering of the bank sector in areas like cash management and low cost deposits. And C. The strength of the iconic HDFC brand. Number three, businesses that require capital but generate low returns on capital. Finally, Buffett talks about the worst sort of businesses which grow rapidly, require significant capital to engender growth, and then earn little or no money. The Indian telecom sector over the past decade has been a good example of this, wherein building durable competitive advantage has proven to be elusive for all the players. The telecom industry in India has grown exponentially over the past decade, 41% CAGR in the number of telecom subscribers over financial year 2 to financial year 17, from 7 million subscribers in financial year 2002 to 1200 million subscribers in financial year 17. Industry leader Bharti Airtel has maintained its market share by number of subscribers at 20 to 24%. Such exponential growth has been fueled by heavy capital investments. Over financial year 07 to 17, Bharti's standalone business, which largely includes its India telecom revenue, had higher cash outflows from investing, that is, capital investments, than its operating cash flows. Despite these investments and exponential growth in its subscriber base, the firm delivered only 13% revenue CAGR for its Indian telecom business, with its earning declining from 40 billion rupees in financial year 2007 to a loss of 99 billion rupees in financial year 2017. As a result, pre-tax ROCE declined from 28% to 7% over the decade using standalone financials. Such businesses demand for capital Such businesses demand for capital is insatiable, and investors who have chased growth of such companies have ended up destroying wealth over long periods of time. Bharti Airtel's share price in August 2017 is 2% lower than what it was 10 years ago. Page Industries, a case study for greatness. Page controls the master franchisee of Jockey, Innerwear and Leisure Wear, and Speedo Swimwear in India. As shown in the exhibit below, over the past 15 years, that is financial year 2002 to 2017, the firm has consistently achieved revenue growth in excess of 10% per annum and return on capital employed in excess of 15% each year. In compounded annualized terms, over the past 15 years, Page's revenue have grown at 31% CAGR, earnings have grown at 40% CAGR, and ROCE has averaged a staggering 55%. Exhibit 9, Page's ROCE and revenue growth has remained very consistent over the past 15 years. As per Warren Buffett's categorization of businesses, Page Industries is a perfect example of a business that requires capital to grow and generates a decent ROCE. Over the past 10 years, Page has, on an average, reinvested around 50% of its operating cash flows back into the core business via fixed asset investments to expand its manufacturing capacity. Despite this, the firm has either maintained or improved its ROCE over time, implying that it has successfully and consistently generated a healthy ROCE on the reinvested capital as well. Exhibit 10, Page Industries has allocated capital steadily towards capex and dividends over the past decade. Exhibit 11, Page Industries has maintained a prudent dividend payout ratio and debt equity ratio over the past decade. Consequently, Page's share price has compounded at 45% per annum over the past decade, that is July 2007 to July 2017. More importantly, although the stock's trailing price to earning multiple pre-rated from 27 times in 2007 to 70 times in 2017, a CAGR of 10% in the PE multiple, the firm has delivered 32% earnings CAGR over this decade. Hence, almost 80% of the Page share price performance can be attributed to its earnings growth and only the balance 20% to its P multiple re-rating. Simply put, Page share price performance is largely attributed to its healthy earnings trajectory rather than the re-rating of its P multiple. So, how has Page delivered such earnings growth over 15 years despite operating with only a single brand in a single category? With competitors ranging from domestic incumbents like Associated Apparels, which had operated Jockey's master franchise in India during 1960s, VIP, Rupa, TTK Tantex, Triumph, Enamor, and Lovable Lingerie, to international players like Hanes, Benetton, Fruit of the Loom, USPA, FCUK, La Senza, and Tommy Hilfiger. One would think that making innerwears is not a rocket science, and given that innerwear is neither on display, at least not in India as yet, when worn by users or widely spoken about in everyday conversation, the presumption would be that brand cannot possibly be that important. But think about this, comfortable innerwear is much more important than the clothes we wear over it. Innerwear has to be strong and durable. As if all this was not enough, difference in physiques, weather related factors, and consumer preferences of comfort in India are not entirely similar to those abroad. Consequently, the product design, fit, and fabric composition of an undergarment stock keeping units has to be indigenized in order to be successful in India. This is a curse if you get it wrong and a boon if you get it right. If a consumer accepts a particular style and brand, it is highly likely that she or he will stick to it. Therefore, consistency of product quality and design over a period of time across geographies is critical for a brand to avoid losing satisfied consumer. Finally, a steady stream of new products keep distributors and retailers active and interested. Selling the same product year after year does get boring. The feel good factor of consumer purchase in innerwear is driven by a combination of fresh introduction of designs across subsegments of innerwear and fresh introduction of colors within exciting styles. Very few clothing brands have got all these factors right in India. The firm has been very focused on deepening its moat for a very long time. Page's journey with Jockey goes back to 1959. Four generations of Genomical family, the promoters of Page, have focused on the undergarment business and have no intention of diverting to anything else. As a result, unlike many other promoters in India who end up diluting their firm's ROCE by misallocating surplus capital, Page has maintained strict capital allocation discipline over the past 2 decades. Page has been judicious while balancing the source of funding between equity and debt for its growth. See exhibit below. Page makes capex decisions based on assessment of business growth and expansion. The assessment includes understanding subjects like market expansion and penetration, leveraging new technologies to reduce cost of production, investment in software, backward integration for cost advantages, etc. Exhibit 12 Sources of funds for Page from financial year 2007 to 17, large internal accruals. Exhibit 13 Application of funds for Page from FY 2007 to 2017, Capex plus dividends.